Hello everyone, I'm Mike Ruger. I'm the managing partner at Greenbush Financial Group. We had a client ask a really good question this week about what the Fed is doing right now. Jerome Powell, the head of the Fed, recently announced that, hey, we're going to try and intentionally spur inflation. And that spooked a lot of people because if inflation is going up, that means prices are going up. That's usually harmful for the economy. But what the Fed is doing is not necessarily trying to spur hyperinflation. They're more trying to avoid a deflationary long-term environment because that can be super harmful for the economy down the road. And the reason for that being is if you think about deflation. So deflation is prices are going down, which short-term deflation says, well, if prices are going down, I can purchase more stuff for the money that's sitting in my bank account. But long-term deflation, prices going down for long periods of time, is actually very harmful because if you think about it, prices are going down, which means companies are making less money. If companies are making less money, they have less profits. If they have less profits, then they have to cut costs. And cutting costs means they're probably cutting workers. And if this happens across the entire economy, you have all of a sudden the employment rate going up pretty quickly. So to completely avoid that scenario, the Fed is now working to try and get inflation back to a healthy rate. And their target is about a 2% inflation rate, which has that opposite effect of deflation, which is prices are going up a little bit, companies are making a little bit more money, they can pay their employees a little bit more, employee spending goes up. So it kind of has that reverse effect as long as it stays within that healthy range. Now, if they don't do anything and all of a sudden the economy starts recovering and they kept rates too low for too long, that's when you get hyperinflation, where prices get out of control, the Fed's way behind, and now they have to increase rates very quickly by large amounts, and the stock market doesn't like that. The stock market likes small, gradual increases so it has time to digest that throughout the economy. So as investors, I really think it's three things that you just have to be aware of. So one, there could be some short-term gyrations in the market as the market really acknowledges this change in stance by the Fed and they could be raising interest rates, and the market could have some short-term negative impacts, but knowing it's for the long-term better good of the overall economy. The second is any individuals that are looking to refi, take a mortgage, companies that are looking to take on debt. It is a change of stance to say interest rates could be higher 3, 6, 9, 12 months from now. So do you potentially take action now as opposed to waiting? And I think the third item is with the bond market. So bonds that are long duration bonds that are out more than 10 years, those benefit the most when interest rates drop because the prices go up by the most. But remember, it's the reverse effect. As interest rates start to go up, those bond prices will start to drop, and it has like that rubber band. So any bond investor that have been really long duration, they really have to look at their bond portfolio to say, if interest rates go higher, what impact could that potentially have on the fixed income portion of my portfolio? I hope this was helpful. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.